And now to one of the fastest growth stories in years, exchange-traded funds, or ETFs, products which track indices. A recent McKinsey report estimates ETF assets could value $4.7 trillion by 2015. Well, back in 2003, Graham Tuckwell invented exchange-traded commodities, ETCs, in Australia, which invest in commodities like gold. ETCs are now worth more than $175 billion globally. Mr. Tuckwell's ETF Securities has over $25 billion in assets, and I spoke with him earlier. Graham Tuckwell, welcome to the programme.
Thank you.
Now, it's been an extraordinary decade for you, Graham. Where did you get the idea for exchange-traded commodities?
Well, in fact, it came from the Australian Stock Exchange. I was working on the Australian Gold Council with their investment committee, and they came to a meeting and they said, look, some of our clients want to trade derivatives on gold, but we need the underlying to be listed. And I thought, that's a good idea. And they went around the table and said, well, who's interested in helping us do it? And everybody else sat on their hands. And I said, well, no, this is a great idea. I really want to do that. So I said, well, I'll do it, but I'll end up owning it. And everybody said, yep, that's okay. So I went off and did it. And I got in contact with a lawyer, Bill Fuggle, and I said to him, Bill, this is what I'm trying to do. Now, are there any precedents for this? He said, no, none at all. However, there were some securities based on wine being listed on the stock exchange. That might, in fact, give you a head start here.
So it was wine?
So it was, in fact, based on wine being listed and traded on the stock exchange.
It has to be backed by gold, of course. How much bullion do you have stored in ETF securities, for example?
Well, we've got almost $20 billion worth of gold physically sitting there in the bank.
That's more than the Bank of England?
Yes, exactly. And, you know, for every security that we've got on issue, it's backed by physical gold in the bank.
Mm. Of course, during this time, during the last decade, you got involved in ETFs, exchange-traded funds, and also synthetic ETFs, which, of course, have been controversial. Now, 2008, the financial crisis, you know, I read your story and it's heart-stopping. You had, at that stage, I think, over 100 of your products secured against the American insurer AIG. In September, what happened?
Well, that was quite an interesting journey, because when I started the concept of commodities that weren't backed by physical gold, but were oil and other things like that, I wanted a strong credit. And I thought, well, I'm not 100% sure about the banks. I'll go to a AAA company. And the AAA company I approached was AIG. And it was a nightmare for us, and it was a nightmare for our investors. But we did manage to get through that. We managed to convince the US government and AIG to collateralise those debt, and there was no money lost by any of our investors.
Was there a point, though, that you thought of calling in AIG?
We did get to that point. We were just about to issue a notice of demand to AIG, and hence the US Treasury in those dark days in September, a cash demand for $4 billion. And we were just about to issue it, and at the last moment AIG turned around to us and said, listen guys, this is going to cause enormous problems in Washington. We'll put up collateral. They put up the collateral and we withdrew the notice of demand.
So an Aussie company almost caused the collapse of AIG?
It was a pretty close thing.
Synthetic ETFs have received something of a negative press, partly because of the collateral, partly because of this issue of what's behind it.
There has been a lot of education. There were questions asked by some of the regulators as to what does synthetic ETFs mean as compared to physical ETFs, and that's a fair question. And we have in fact spent, and others have spent time with regulators explaining to them about synthetic ETFs. And in fact, in the most recent ESMA guidelines, the European market regulator with regard to this, just out, they've in fact concluded actually synthetic ETFs aren't too bad at all. Some of the problems with these physical ETFs is stock lending. Now we're going to roll back some of that stuff. So it's interesting, some of this has backfired.
But it's as good, synthetic ETFs are as good as the counterparty risk is, bottom line.
They are, correct. But for our products, we don't rely on the counterparty risk. We say, thanks very much, you're a good counterparty, but we want collateral, and we want to make sure, as good as your credit is, we want all of your credit backed by other security in the form of collateral.
For financial planners, for small investors, What about ETFs and ETCs? What if you don't know what you're doing? What about thinly traded securities? And what about leveraged ETFs? I mean, do you really need to know what you're doing?
They are traded on exchanges. We have health warnings over our prospectuses. Please don't buy these unless you know what you're doing. And certainly with regard to the leveraged and the inverse, it's a double health warning to make sure that people don't go into those areas. But for those people that do understand them, they're extremely good products.
I noticed that most of the fund management industry, and indeed I assume our own future fund, is not really invested much in commodities, in ETFs, in ETCs at all.
The Australian market, if they're investing in the All Ordinaries, has a large exposure to commodities because of the makeup of the companies within it,
yes,
such as BHP, Billiton, etc. We would argue, if people want exposure to commodities, and particularly gold prices, instead of buying gold companies or resource companies, a better way of getting more direct exposure is buying the exchange-traded commodities that gives them that one-to-one correlation with the commodity price movements.
Do you think the ETF market is going to eat up the listed investment company market here?
I think there is a wall of money, and there has been for some time, moving from the actively managed market to the passive market, which is what ours is. Ours is a cheaper product. We don't try and pretend we outperform anything. We just track the indices that the product is designed to track. It's a lot cheaper, it's a lot more transparent, and that's why the wall of money globally has been moving to ETFs.
Finally, you had Goldmans looking at a sale of your own company. You're now known as the sort of £500 million man. You were looking at putting ETF securities on the block for, I think, about £1 billion. You've taken that off. Why?
Yes, we got interest for the company quite clearly, but not necessarily on the terms that we felt were best for us or best for the investors. So we just decided to put that
So presumably you still
side.
think the market's got a fair way to go?
I think it's got a fair way to go, yes.
Graham Tuckwell, we hope you get you back to Australia at some point. Thank you very much for joining us.
Thank you.